All right, hello everybody, and welcome to yet another episode of Buidl Crypto, a platform where we bring the builders of crypto economy together and talk about the opportunities and challenges of building products in crypto. Today's topic is a very special topic. We are going to discuss where yields in crypto come from. What is the secret sauce behind that? And for that, I have been joined by four esteemed guests that I'm going to introduce soon. But before I do that, I just wanted to kick this off with a legal disclaimer from my friends and lawyers at Coinbase. Please note that today's conversation is for informational purposes only and does not constitute legal or investment advice. We may make forward looking statements, and actual results may vary materially from today's statements and are subject to risks and uncertainties. It's always a mouthful for me to say that out loud, but it's always good to say it out first and then get in the discussion of today. Like I mentioned, we're going to talk a lot about where yields in crypto come from. And many of you probably already know this, but it's worth repeating the stat that I just picked up from DeFi Pulse yesterday. There's more than $90 billion plus locked up in crypto assets across DeFi protocols, which is a 300% increase from last year. While the headlines are made by things like there's a 1,000% APY or an 8,000% APY. There is more to that. And today we are going to deconstruct that. We're going to figure out, where do these yields come from? Are they legit? Are they the right way to go about building scalable products? And for that, I've been joined by four amazing guests, and I'm going to go around the room now and introduce them. And when I do so, fair warning to everybody here, I will be asking you a fun fact about you, something that if we were to read your Twitter or LinkedIn, we wouldn't be able to guess about you. So let's start with Ming Zhao, who is the CEO of Atomic Walls. First of all, Ming, welcome to the spaces, and we'll love to know a fun fact about you.
Great. Hey, everyone. I'm Ming. You guys probably know me by some of the threads that I write on Twitter. A fun fact about me is A, I'm Canadian, and B, I can drink an entire bottle of black vinegar. So if anyone wants to challenge me to that contest, I'm up for it.
That is such an amazing fun fact. I would have never guessed that, Ming. Thank you for sharing that. Next.
Challenge is still
That's
open.
right. We'll see. Maybe one of the audience members will ping you and say, I'm up for it. Well, welcome. And we're also joined by Julian Ko, who's the co-founder of Ribbon Finance. Julian, welcome, and tell us a fun fact about you.
Hi. I'm the co-founder of Ribbon Finance, which is a protocol that builds structured products in crypto. Fun fact about me, I started my crypto career as an intern at Coinbase a few years ago.
Amazing. Well, the world is a small place, and while we miss you at Coinbase, we're also excited about the success that Ribbon Finance has had, and we're going to deconstruct some of those things today as well. So welcome. Next up, we have two folks from Coinbase. So I'm going to start with Yuga Kohler first, who's the staff software engineer for crypto at Coinbase. Welcome, Yuga, and tell us your fun fact.
Thanks, Sanjan. Hi, everyone. It's really great to be here. A fun fact about me is that I am an orchestral conductor. So I went to grad school for music, and I still kind of conduct orchestras around the world today.
That's impressive. If you follow Yuga, you will see some of his impressive photos and videos. It's really impressive. Thank you for joining us, Yuga. Dennis Huan, who's also a senior software engineer at Coinbase. Welcome, and tell us a fun fact about you.
Hey everyone, nice to meet everyone. Fun fact about me, when my parents immigrated to the United States, they watched a movie, the very first movie they watched, and then decided to name me after the movie. And the movie was Dennis the Menace.
That is funny. That is awesome. Well, great fun fact as well. So welcome, Dennis. So welcome to all the speakers. And now we can get into the meat of the conversation today. So to get started, we're going to jump straight into one of the things we do on this spaces, which is I'll speak out a hot take from the industry. It might be right, it might be wrong, we don't know. It's a hot take, it's a meme, or it's a hot take in the industry. And I want to go around the room and take each one of you's perspective on that hot take. Please give us your unbiased, candid opinions about this hot take as well. So let's start with the first one. The first one is, there's a saying which is that one person has to lose money for another person to make money in the yield game. It is a zero-sum game. Let's go around the room and see if that's a true or a false statement. We'll start with Ming on this one.
Sure. So, in some sense, from a pure like market sense, of course, there someone does have to lose for someone to gain, but in the aggregate sense, when there's real value being created and the underlying pool of wealth is growing, then obviously like everyone, it's kind of like rising tide floats all boats and things net out, and like you might be losing a bit in like a micro perspective, but due to rising tides, you're overall like much better than you were before.
Yeah, so it's the macro that matters in the long run. Well, let's bring in Yuga. Yuga, tell us your perspective on this.
Yeah, I mean, I definitely agree with Ming. I think one of the amazing things about DeFi is the amount of aggregate new value that's being created through financial innovation. I think some of the protocols that are being deployed today are really remarkable in how they design the mechanisms to incentivize various parties and facilitate the transmission of value. I do think what is pernicious is the sense that sometimes protocols give that everyone can win, that if everyone participates, the numbers only go up. And I think we've seen that blow up in fantastic ways, as I'm sure we'll touch on recently. So I think we all need to exercise caution, but I do think there's an opportunity for everyone to win. We just need to be careful.
Great point. Let's see, Julian, your perspective on this.
Yeah, I mean, I think I disagree quite heavily because there are some activities you can do, like providing liquidity in an AMM and earn yield that way. And that's sort of positive sum for everyone because you're actually earning yield from a service you provide. So I don't think necessarily someone's losing in that scenario, but of course, I do think a lot of DeFi projects today are sort of Ponzi schemes where people are losing, and they do parade this wag me thing all the time. So although I do disagree fundamentally, it is a very common thing as well.
Yeah, I think we're going to touch upon some of those Ponzi schemes in the wild west of DeFi today as well. One thing I wanted to get a take while we are going through the hot takes is that maybe for the audience that is here, tell us what is a DeFi yield farmer? What's the typical user journey? And I'm pretty sure some of you are DeFi yield farmers. So tell us what is that, and tell us what the user journey of a DeFi yield farmer looks like. Who wants to take this one? Maybe Dennis, you want to start?
I can probably take this one. I do this a lot. So I'd say a DeFi yield farmer is someone who takes their assets, whether they're beta assets or stablecoin assets, and then brings it to a protocol, kind of allows that protocol to leverage their assets, and then effectively earns interest on their assets over time. And I'd say a typical user story would be, you take your Ethereum, go stake it in a lending protocol. Lending protocol will pay you some interest on top of that. And then every so often, maybe every week, you'll go and pull down that interest and compound it into either that farm itself or another farm if the lending protocol is already not doing it for you. Yeah, I think that's pretty much it. And then every now and then, if you're a more advanced DeFi yield farmer, you might rebalance and kind of optimize the yield across several strategies rather than just a few.
Yeah, so let's talk about some of those strategies actually. Maybe at first, before we get into the specific strategies, let's talk about at a high level. Ming, I think you wrote a very good Twitter post one time, a tweet storm one time, where you mentioned where all the yields come from. So give our audience a summarization of your tweet storm about where these yields are coming from.
Yeah, I think at the end of the day, you can kind of slice and dice it a couple of ways, but a couple of ways, like Julian mentioned earlier, you can go to an AMM and earn kind of the token rewards plus some fee for providing liquidity, And I guess that going to an AMM already involves two methods already. So one is the token rewards and one is the fee structure rewards, and other fee structure rewards are such as staking, where you provide you provide your collateral and then you get back a certain percentage from the service of providing your collateral itself. And then a third method is from options writing, which I'm sure Julian can tell you way more about than me. And then four, I would say, is basically almost like buying into a fund, where like funds play on various strategies, market neutral strategies. Particularly, good example is basis trading, where you're making off of the spread difference between two assets, and that generates quote unquote yield over time. So there's it basically, like, we kind of think about it in these like four methods as we know of it today. But kind of the TLDR is, it comes from providing a service or from trading.
Yeah. So maybe we'll go to Julian. Tell us your favorite yield mechanism, and break some of these things down for us, Julian.
I would say like the most fundamental driver of yield across DeFi, across finance even, is sort of the demand for borrowing assets, and that drives everything else. Because I suppose people use that as like the base rate for what yields look like. So I mean, when markets are bullish, people start borrowing more to leverage and to do all sorts of different activities in DeFi. So I think that's like the most vanilla and most common things that you can see. And when markets pick up, yields across all these money markets will pick up, and yields across like almost every DeFi protocol will also pick up. And when markets are a bit quiet, like now, you can see that sort of go down as well. So yeah, I would say that's the simplest to understand and the most fundamental driver in DeFi today. Yeah, and I mean, all these money markets like compound finance, I think they are like the base layer of these types of rates and this type of activity.
So maybe we can pick one other hot take, because we're talking about the different types of yields that can come. One is a stablecoin yield. You can actually, in the scenario that Julian just mentioned, you have stablecoin, they earn yield. And as many of you know, stable coins are backed by, in some regards, like USDC as an example, is backed by dollar in many regards. So there's a hot take, which is, can stable coin yields still beat inflation in a bear market? What do you guys think? Maybe we'll start with you.
Yeah, I tend to believe that getting yield from your stable coins might be one of the best mechanisms during a downturn. We see massive volumes, for instance, on platforms like Curve, which provide liquidity pools across different stablecoin pairs, even to the point, right now I know there's like a drainage of MIM going on with the TriCrypto pool. But stablecoins really provide an opportunity to tether DeFi value to sort of real world currency value. And if you're earning yield on some of the more let's say reputable stablecoins, whether that's USDC or DAI, you can be fairly secure in the knowledge that you're going to be able to redeem those stablecoins for dollar currencies. And certainly, as more stablecoins come online across various fiat currencies, so like the euro or the British pound or what have you, there are going to be more opportunities for arbitrage and earn yield on your stablecoins. So I think if you're looking for a DeFi yield play during a time when DeFi assets and maybe the equity markets aren't performing as well, then looking for optimizers, whether that's Yearn or Grow Protocol, things like that, stablecoin yield farming might be a good way of making sure you're beating inflation even during a bear market.
You guys all heard it here. Well, let's take Ming's opinion. Ming, what do you think about this hot take?
Yeah, I wouldn't be so quick to compare stablecoin yields to inflation, because the relationship really isn't direct to me right now. So there's two theses. You could either say like inflation is going to significantly pick up, and to the extent that it's not already priced into the market, and Fed is going to hike 3 times, and markets are going to be super bad this year, and people are going to have bank runs and try to pull out of DeFi. Like that's one thesis. In which case, just there will be overall lower, lower desire to borrow stablecoin, and therefore yields on stable coins will go down. And then it's unclear whether what those yields will be vis-a-vis inflation. But it's not directly tied to inflation. It's more like the stablecoin yield is directly tied to the desire to borrow or the demand for borrowing from institutions, etc. And so I think those two aren't like totally correlated. And then another take is, well, there will be a meme going around that obviously like crypto is the best way to hedge against inflation, or crypto assets are anti-inflationary, and therefore we see like a new or a counter bear market kind of influx back into crypto, and therefore that will prop up the yields relative to yields in traditional finance, and therefore it's a better bet to to try to earn your yield in crypto rather than in traditional finance. And so it's not entirely clear to me which of those two narratives is going to play out this year. But those are kind of my two perspectives on what could happen.
Which one are you betting on, Ming? That's the $1 million
Which
question.
one am I betting on? I think there will be an initial, and we've already seen an initial bank run, or I call it a bank run, but really it's folks liquidating in order to pay their bills, and then like not liquidating because they want to out of crypto necessarily, but because they have to, which then triggers the next wave of people that liquidate because they're just paper hands. And then it'll sell off to a certain point, and then people will buy back in, and then I think there will be that narrative stepping in to say traditional markets are weak, and crypto, like, this is a as good of an opportunity as any to really try to bolster up all of the innovation inside DeFi. And so I think it will go through those narratives like one after the other, and we've kind of already seen the first narrative kind of play out, and I think we will get to the second narrative in like Q2 of this year.
Got it. Very, very, very amazing insight. Well, so maybe another question, Julian. This one will be for you. Should people actually associate high yield necessarily meaning high risk? You hear all the time, there's this amazing, I'm not going to use names, but like 1,000%, 2,000%, sometimes 100% yields. Does that necessarily mean that the high yield necessarily is high risk for me?
I think if you asked this question like 2 years ago, the answer would be no, because DeFi was still so small and there were a ton of market inefficiencies. Even if there was like a large sophisticated player who wanted to come in and like take those rates, maybe it would take them a few months to ramp up. But I would say in the current market environment, a ton of sophisticated players have already deployed their assets into crypto, and they are very quick into these opportunities. So I would say in 2022, yes, it's sort of high yields generally mean high risks, because otherwise some of these really, really large funds would have already come in and taken that arbitrage.
Got it. So right now that translates into high risk, which is an interesting perspective. Let me bring in Dennis as well. Dennis, what do you think? Do they really mean high risk as well?
Yeah, so this was a tricky question. I think, I've seen this meme going around where there's like a bell curve, and in the middle of the bell curve, it's like, 50% APR, maybe that's a Ponzi. But then if it's like 10,000% APR, it's actually a good risk reward play. So I think if you were to compare the highness of the yield to TradFi or some of the really stable mainnet yields on like Yearn, then yeah, it's definitely higher risk. But if we're thinking about like how institutions might see it, they're definitely not touching anything in the middle of that bell curve or to the far right of that bell curve. They're staying to the far left where the lows are really low. So in effect, like relatively, that the middle of the bell curve is already high yield, but it's not as high risk as like that 10,000% APY on the far right. So I think right now we can still get away with high yield, medium risk, and it'll still be relatively safe. For example, some of like LPing a stable coin pair on another chain, for example, that gets you like 15% or so, which is a lot better than like the 7% you get on mainnet. But I would say that's like similar risk, not double the risk, right?
If I can just jump in quickly,
Go for it.
One thing I think we all need to be cognizant about is like sort of the denomination of the yield. So, you know, when you see 10,000% APY on a protocol, often that yield will be dispersed in the form of, let's say, native governance tokens or other types of coins that whose intrinsic value is not clear. Now, there may be a market for it because they've, you know, leveraged the initial supply to bootstrap a liquidity pool, and so it's trading against ETH or USDC on Sushi and Uniswap. But when you see tokens that go up, or sorry, protocols that offer 10,000% APY, and you notice that you have to first convert it to some type of coin, you have to stake it, and then everything is being paid out in some obscure governance token. I think that's fundamentally different from, let's say, you know, a stablecoin protocol where you know you're going to get USDC in return, or let's say, you know, an Ethereum or Bitcoin interest rate protocol. I mean, there's a reason that interest rates on things like Ethereum or WBTC are so low. It's because they aren't sort of speculative assets, relatively speaking. They're relatively hard money. So if you're earning 10,000% on a governance token whose value proposition is not super clear, I mean, APY is calculated in terms of the token. Sure, that's true. But in terms of the true value that you're accruing, the true yield that you're accruing, that number, you know, may not correspond to anything meaningful. And so I think that's sort of what the risk you're taking is. The risk is, well, is the thing I'm being paid out in actually valuable?
That's right. And especially in the early days of a protocol, early days of these things, they may or may not be valuable. But then over time, hopefully the bet is they will become valuable as time goes by. And we don't know which one of those will be successful. So yeah, that's a really good characterization of risk. So shifting gears now to the next topic that I wanted to cover was like we talked about yields. Yeah,
wait,
go ahead.
I have a disagreeing perspective on that last one.
Tell us more.
All right. So I actually totally disagree. I think, you know, there might be some tiny correlation between risk and yields today, but I definitely don't think it's like a straight, you know, like 0.95 plus like R squared value there. If you can, so my hot take is that I think the yields in, let's just take AMMs, have much more to do with the charisma of the founding team and their distribution strategy. So, and the reason why I say that is because if the majority of like an AMM protocol's yields come from the token distributions, the majority of the yield, like what that's worth, is going to be dependent on how much, you know, how much that token is trading in the market. And that ability has, and that yield or the value of that token has more to do with how great the founding team has been at, you know, growth hacking, like meme generation, distributing their, you know, the fact that their token exists and is great across, you know, through various different channels, like going through the right, you know, their investors, going through the right influencers, etc. And so like obviously if they give you, if you receive one token and you received it at one, roughly worth the value of $1, and then tomorrow it's worth 5, and the day after it's worth 10 because this thing is getting like really popularized really quickly, then like your yield, like 99% of that yield is based on the founding team's ability to really evangelize their product. So I would say like, and that has nothing to do with risk, right? And I would say like in general, risk is really hard to evaluate across the board. Like, do you want to break it down into credit risk, counterparty risk, like macro risk, asset class risk, correlation risk. There's so many different ways to break down, like risk really breaks down into all these different factors. And so many of them right now are just not tied to the yield itself.
Very interesting perspective. This is what I love about having folks on the call with varying different perspectives, so our audience gets to hear the whole spectrum. So thank you for sharing that, Ming. I mean, in the same spirit, let's go one level deeper. You talked about different types of risks. You talked about different types of yield farming strategies, and we talked about whether there is truly risk in early adoption of these strategies or not. But for someone coming from traditional finance background, why is it that DeFi yields are higher than TradFi yields? I mean, traditional finance has existed for hundreds of years, and all of a sudden we come to DeFi yield and we're like, wow, we can get 10%, 50%, 100%. Let's not talk about 8,000% maybe, but like in that range. So tell us, who wants to break it down for us? So why are these DeFi yields so much higher than TradFi yields? Maybe Julian, you want to take a stab at that?
Yeah, sure. I think my perspective is DeFi is still relatively early in its life cycle. I mean, most of the iconic DeFi projects or companies have only been around for maybe 2 or 3 years at most. And I mean, yields generally get corroded when it becomes a more crowded trade. So I would say that right now, maybe we're still in the phase where large pools of institutional money has yet to onboard into crypto, into DeFi, and that's sort of the imbalance of unlocking a global demand for borrowing, let's say, is not matched with like a global supply of assets from large institutional folks. So for now, there is like an imbalance, and that's maybe what's keeping yields pretty high. Obviously, I think this will change in the next few years, but I mean, we have already seen that in the last 2 years. I think it's pretty obvious that institutional adoption of this stuff has generally driven down yields. But yeah, I would say we're still maybe relatively early in the life cycle.
Yeah, I mean, institutional players are definitely entering this space in a boatload, so to say. Hugo, what's your take on why DeFi yields are higher? And as you all are answering, the follow-up question, just to remind you all, I'll be asking is, do we think they're sustainable? You know, because at the current pace, they may or may not be sustainable. So go ahead, Hugo.
Yeah, I mean, going back to Ming's point about like, what's the relationship between risk and yield and the charisma and of evangelizing and so forth. I tend to think like, I agree that risk is very difficult to numerically calculate and characterize, and there are a variety of different ways of going about it, and it's not necessarily an exact science. I do think the reason that DeFi protocols offer such high yield is because they have to, in order to incentivize users to adopt the protocol, and the hurdle there is what they perceive to be risk. That can be, again, it's hard to quantify, right? But when you're aping into a new protocol, when it's about to launch, sure, maybe the smart contract has been audited, but you don't know exactly how it works. You don't know whether there's a multi-sig wallet behind it or if it's just an EOA belonging to someone. You don't know how robust it is, how robust to attacks it is. And sure, maybe the founders are very charismatic, but they're successful in pumping up the governance token from $1 to $20 over the course of 6 months. But then maybe in the next 2 months, it goes back down to 25 cents. So those are all very real possibilities. And I think the reason that there are such high yields being offered, one is, like we talked about, in the worst cases, there's subterfuge and obfuscation. But in a lot of cases, it's to incentivize people to adopt the protocol despite what the users may perceive as outsized risk, especially relative to traditional finance, where there's literally something called the risk-free rate, right? The U.S. Treasury, and even in equities, there's a sort of long tradition of viewing it as something where time in the market beats timing in the market. Eventually, it'll go up. In order to to contrast with that, going into a DeFi protocol, there is going to be risk. There's going to be perceived risk from the user, and in order to overcome that, I think protocols need to offer high yield.
Yeah, and they definitely have to offer high yield to compensate for that risk. But do you think these things will be sustainable over time? Can yields in DeFi stay high this long?
I think any one protocol, it's not necessarily sustainable. I do think the pace of innovation is so fast and new things are coming up so quickly and in such a robust way that for some time it's plausible that there'll be enough value creation to sustain relatively high yields. Maybe eventually the market will reach an equilibrium state where that's not possible. But certainly for any one protocol, I don't think high yields are necessarily sustainable.
Yeah,
I can add a little bit to that.
Go for it.
I think someone alluded to it earlier where they mentioned that, the institutions have not really entered the space yet. And that's totally true. I think if, you were a DeFi yield farmer over the last year, there's a common anecdote that happens where you discover like a really good high yield DeFi farm. And then all of a sudden SBF finds out about it and Alameda arrives. And then your high yield farm just becomes a normal, very boring, low yield farm. So imagine if there were like suddenly 1,000 Alamedas on chain, taking your yield. There's no way that we're going to have any more higher yield. And that's kind of how I see the progression moving for DeFi versus TradFi, where the more and more institutions discover and onboard safely onto chain or are comfortable moving around assets on chain, the less opportunities there are going to be for some of us as individuals to capitalize on these outside yields.
Yeah, one of the things you hear a lot is that DeFi yields will never go down because of composability. You can compose many of these yield products into different products and offer them collectively as well. So, what's your take? Do you think they will go down? If they will not, why? Tell us your perspective.
So I hope I don't derail the conversation a bit too much, but so I think that comparing to traditional finance, or let's to understand kind of DeFi yield, let's go back to traditional finance yields for a sec. So let's think about the dollar. The US dollar has been a reserve currency for the last, since like 1940s or something. I might have my history wrong, but it's been, the reserve currency for multiple decades. And so, then there was like petrodollars. So what happens is like all the nations are hodling dollars and storing it in their national treasuries. And so at this point, you're like, who is going to be the next marginal buyer of the US dollar? And the answer is like basically no one, right? Because like the entire world has already gotten its demand for US dollar out of its system. And so part of the reason, the biggest reason for all these yields and what fuels projects' ability to generate such high token yields is that there are so many marginal buyers into the entire crypto ecosystem, right? And so because there's just more capital pouring into the entire ecosystem, that's where all the yields are coming from, and that's kind of the rocket fuel that allows these protocols to continue to use yield as customer acquisition cost to get more customers to then fuel the system. And so really I think the question comes down, so the question of are yields sustainable really comes down to, at the macro level, whether you think there will be an acceleration in adopters, new adopters and new marginal buyers into any like crypto project or into the crypto ecosystem as a whole. And as long as that answer is yes, as long as the pie is growing, basically, like, then we have reason to believe that yields are going to push upwards. I don't know if they're going to necessarily stay exactly the same current value or higher, especially for any particular project. But in general, there's this upward movement, because in a flat movement, which is US dollar current traditional finance, we still have like the 2% or whatever in a flat environment. So in a growing environment, we should definitely have higher yields. Also, casual point throwing out there, if anyone here like wants to complain about things in crypto being a dollar, let's just face it, the US dollar is the biggest Ponzi scheme of all. Like, has anyone, right? Like, does anyone complain about how much Jerome Powell has been printing the last 2 years? Like, and then people complain about how much crypto projects are like minting tokens. It's the same thing. Like, like if we're gonna call one thing a Ponzi, we might as well call the entire U.S. government a Ponzi, right? Hopefully no one from the SEC is listening to this conversation. I will exit myself now.
This is the headline of this one, by the way. You know, I love it. Thank you for sharing your perspective, man. I mean, so as we head towards the last 20 minutes of the session, I want to change the topic to the future a little bit. So we talked about the past, you know, how DeFi yields came about, why are they the way they are, whether they were sustainable or not. Let's switch gears and talk about where do we go from here. What I want to go around the room and talk about what are the emerging trends each one of you is seeing in the far edges of DeFi land that you believe will become major trends in the coming months to year. And I want to go around the room and ask for let's start with, maybe we'll start with Dennis and see what he's seeing at the edges of DeFi.
Yeah, I'd say the most recent trend is this like dominant loudspeaker of like vote escrow tokens. And I think this is actually just a trend where protocols are realizing, hey, we basically had an IPO and we don't want people just dumping our token over and over again. So, hey, let's try to rewind the clock, introduce like vote escrow, and then introduce some, you know, revenue share mechanisms, governance mechanisms into that vote escrow behavior. So that those tokens can be locked, reduce that sell pressure, so at least the protocol can maintain their valuation and not just get dumped. This is especially important for some of the earlier protocols that stood up because, you know, as we know, everything on a blockchain is open source, so they can easily just get cloned and copied and deployed on the next chain over and instantly lose market share on that chain. So me personally, I think that the vote escrow related yield is going to be pretty crucial for a lot of these protocols to bring up for themselves.
Very interesting. I'm assuming you're aping into that, huh? Thank you for letting us know that. Awesome. Well, Yuga, what are you seeing at the cutting edge of DeFi and what you believe could become a big trend in the next few months to a year?
Yeah, my answer to this is a little bit meta, but I think one of the really fascinating trends in DeFi recently has been not just the composability of protocols, but the composability of the memes in front of the protocols. So, you know, Dennis just mentioned the VE mechanism, the vote escrow mechanism that started off with Curve. Obviously, there was Olympus Down Ohm had a huge moment with the 3-3 meme, the prisoner's dilemma meme, to the point that, you know, people were putting 3-3 in their Twitter profiles. And then I'm sure folks have heard, like, you know, Andre Cronje, I think that's how you pronounce his name, is about to launch or has launched a VE33 project. So a vote escrowed rebasing token mechanism that's launching on Phantom Network. And so I thought that was like a really fascinating example of how, you know, we talked about how the charisma and the evangelizing of protocols is just as important as the protocols themselves. It's really fascinating how the memes that are standing in front of these protocols as the marketing arms of the memes are also being combined in various ways. You see that also with things like the Pepe meme. You know, DopeX is an options protocol that heavily makes use of that. So it's going to be interesting how, like, these memes that emerge to evangelize these protocols combine in different ways and stand in front of newer protocols as well.
Memes are awesome, man. I love them. I believe you. These things will become big memes as DeFi primitives. Maybe we'll go to Julian. Julian, tell us, what are you seeing, my friend?
Yeah, I mean, I'm a bit biased because this is what we are working on, but I think a category that I'm very interested in is basically, I think, automating a very systematic financial strategy on chain. And I think that's going to be like a very big thing this year, especially with the rise of more types of derivatives. So, I mean, for example, in 2020, the first project to really do this at scale was Yearn, which automated yield farming. And I think Ribbon, which is what we are working on, automates option strategies, and there are a few other projects now which are automating other types of trading strategies. And I think, I mean, DeFi is amazing for this because the smart contract is the brains behind this operation, and as a user, you can trust that this is not like a shady hedge fund that could just run away with your money. You know for sure that this contract is running the strategy that that is supposed to. And I think, I mean, this is just going to be a much bigger thing this year, and hopefully Ribbon will also be part of it.
Amazing. I'm looking forward to it. Ming, tell us what you're seeing.
Yeah, I think what I'm super interested in is I guess the what is at the forefront of onboarding the next billion users or 100 million or whatever. And I think part of that, or what's super important to me, is what does that funnel look like? I think probably no news to anyone here that UX UI in crypto is not great in general.
Tell me more about it. Yeah.
Right, which makes it huge. It's a barrier to entry for your more normie people to get into, to be able to capture DeFi yield, to be able to stake or put some of their net worth into crypto yield generating protocols. And I think yield or Yearn simplifies it a bit by aggregating, but still it doesn't go the full length of really integrating into normie life, as in.
That's right.
And that's what I'm really bullish on, is take someone Robinhood does a great job, because hey, you can you can buy your Dogecoin while you're simultaneously buying Tesla, right? And so that it's just so easy to onboard that way. And then everyone has, or most people have, 401ks or retirement plans, offering crypto as part of your retirement plan, just sneakily embedding it into everyday life. And I kind of consider that distribution channel part of UX UI of crypto as a whole ecosystem, tapping into that frontier between the normie and, or basically onboarding the next billion users. Everything that we in deep in DeFi we don't consider cool, because it's not really doing anything technically challenging, or not doing anything innovative on the impermanent loss front or ZK front or whatever. But it's doing something super simple, which is embedding a really nice and easy UI into everyday consumer life. I think that's gonna DeFi so far last 2 years has been a lot of innovation, and I think that the next year or this year will be a lot more hey, let's just get the easy fish, or the next user who's kind of just a normie.
Yeah, I could not agree more with you. This is such a passion point of my team as well. So I'm going to do a shameless plug here, Ming, which is Coinbase recently launched. You can earn yield if you go to Coinbase app. You can earn yield on your DAI that's sitting idle on Coinbase account of yours, and it's available in 70 different countries. And what happens is, in the back end, what we've done is we've partnered with Compound and others, and we deploy that capital to Compound. And as a normie user, I joke about this a lot, but it is true in many ways, which is that it takes 3 steps to buy Bitcoin. It takes 3 steps to deploy DAI in Coinbase app to earn yield. And by the way, it takes 3 steps to buy tomato in the Instacart app, just FYI. So it's that easy. A caveman can do it, kind of an analogy. And we are very passionate about bringing the benefits of all sorts of yield generating opportunities to the normies, as you may call them. We have 70 million plus users, so we're very excited about that. And I'm glad that you brought that up. That we have to solve that problem so people can participate in this without having to truly have to learn all the nuances, all the tricks of the game, so to say. And I know, Dennis, you messaged me saying a message from our sponsor. Yes, this is a message from our sponsor. But moving on to the next topic, which will probably run us to the end of this session, which is, many yield products are quickly moving to multi-chain world, and I think we can all accept that multi-chain is here to stay. So how important is multi-chain dominance for these protocols? Do you think these protocols have to adopt this multi-chain world that we're about to enter, if not already entered? Let's go to Yuga.
Yeah. So, I mean, I have a couple of thoughts here. One is, yes, we will be in a multi-chain world. I don't think it's forever going to be as many chains as we have today. I think things will consolidate. You know, we're seeing a lot of pressure on Luna and UST right now. Uh, who knows where that will go if that gets all liquidated on Anchor? It's not looking good for them. And you know, who knows what other types of systemic risks there are out there. That being said, I do think for certain businesses, you know, like Coinbase, it will be important to be multi-chain and chain agnostic. But for other more niche businesses, whether it's like a specific DeFi protocol or something like that, I think it's probably going to be entirely possible to exist within an ecosystem. Maybe it's just, for instance, ETH and associated L2s. I don't think everything has to be on Binance Smart Chain and Solana and Phantom and Ethereum. On the other hand, bigger businesses that make their money from flow or throughput, it will be very important to be multi-chain. So I think the long and the short of it is, first of all, I think the chains are going to consolidate. I don't think it's going to be as many as we have today. I think for certain businesses, it'll be important to be multi-chain, and for others, they can probably be strategic and choose just a few.
Yeah, great point. Julian, where you sit, how does the world look like? What is your vantage
Yeah.
point?
One of the big focuses for us this quarter is actually a multi-chain strategy. So we first ventured out. We've been on Ethereum for basically like a full year, and we just finally launched a deployment on Avalanche end of last year. And I think this quarter we are focused on, as previously mentioned, picking a few strategic chains that we want to be on. I think for projects, it just makes sense from like a business perspective. Um, there are more users on different chains, and there are more assets on different chains. So if you can easily deploy there, why wouldn't you? So I think, yeah, it is a big focus for us, and we see it as like the next leg of growth for us, because we tap into these completely new customer groups and new pools of assets, and I think that's how we basically scale.
Yeah, I think that's the future. I think from your vantage point makes total sense. Maybe the last 10 minutes. Let's do this. Imagine we're having this conversation a year from now, and we're having this conversation. Where do yields? Where is it coming from? What are the new primitives for yield, etc.? What is the world you imagine a year from now? Imagine that world, and what would you like it to be? Imagine that world that you would like to materialize in the next year. We can talk about regulation, we can talk about technology, we can talk about anything that you would like to see happen in the 1 year time horizon. So maybe I'll start with Dennis. Dennis, take a look at your crystal ball, my friend. Tell us, in a year from now, what would you like to see happen?
I think a year from now, I think I'd like to see, one-stop shops for kind of distributing your assets across all chains. I think it's definitely going to be a multi-chain environment. Right now, I know a lot of CeFi is trying to attempt that, and a lot of bridges and bridge aggregators are standing up as well. So just being able to have more fluid flow of funds, I think that would make some of these like yield arbitrage opportunities across chains much more even. And then, one thing I'm not hoping to happen is I'm not hoping that institutions will quickly adopt DeFi and take away this easy money that is yielding. But I'm pretty sure that's going to happen real soon once they figure out, all the ops to do so.
Yeah. I mean, I think there's definitely an onboarding that I can imagine happening for institutions through Aave Arc and the Fireblock partnership as a whitelister. So that'll be an interesting space to watch as well for institutions as well. Ming, look at your crystal ball and tell us, when we meet again in a year from now, what is the world that you want to see happen?
I don't know if it will happen, but I want to see tokenized stocks on chain.
Ooh.
And I mean, obviously it's like, number one on the SEC's
yes.
do not do list, because they're afraid of, because they think it's actually the biggest threat, like the straw in the camel's back that will, break traditional markets and move it to crypto.
Sorry, Nick, doesn't FTX do this in certain jurisdictions already?
But you're not allowed to trade those if you're a U.S. resident.
Right. Okay, so you're talking about in the U.S.
Yeah. Yeah, or I just I see it really taking off, and I hope it really takes off. And it's inevitable that it takes off because it's really dumb that we have to start trading at 9:30 a.m. Eastern time, and if you live in Hong Kong, well, fuck you, basically. Like, fuck you for living in Hong Kong. You don't get to trade US stocks at normal hours. And so that's something that I think is inevitable, that it will come to fruition in maybe not in a year, but certainly soon in the medium term.
Yeah, you definitely see progress being made, at least in this year. Maybe it will not come to fruition completely, but we'll make progress, hopefully. Let's go to Julian. Julian, what is your prediction of what you would like to see materialize?
So this is not so much a prediction, maybe more of like a hope thing. But I mean, firstly, obviously, I think we all want crypto all-time highs again. So hopefully the next call we do next year, BTC will be at 100K or something. The second thing is also something I want is I think this year or 2021, so much of the attention from retail and the mainstream has been around NFTs, and hopefully we do get like a rotation of interest back into DeFi. So yeah, we'll see. But I completely understand why NFTs are just much more interesting to the regular person than all this financial stuff.
Yeah, I mean, I want both to win. I mean, but yes, you're right. I mean, we want a little bit more interest back in DeFi. I remember right now my Twitter feed is full of things talking about NFTs, and just about 6 to 9 months ago, they were all things DeFi. So we want to balance back. I agree with you. And let's go to maybe I didn't cover you guys. Let's go to you.
Yeah, one thing this is sort of tangential to DeFi, but you can argue it is DeFi. In fact, like the most decentralized possible type of finance is like decentralized private equity. So like I think Balaji had a great post on this, basically using on-chain mechanisms to invest, not just at the level of a protocol necessarily, but like to participate in venture capital, so like to fund a project, or even to tokenize a specific person, like a person, like an influencer or an artist or things like that. That can be through NFTs and through other means. But I am like, my hope is that within a year, there are like really nice ways of onboarding people to participate in decentralized finance at the earliest stages, which is where a lot of the gains are made anyways. Like, if you get in the seed round, you have a hope of getting 100 or 1,000x, whereas if you're post token sale, maybe you're aiming for a 20x in the good case. So I would really love to see and hope to see within the next year tools coming online so that people can participate as venture capitalists through decentralized finance.
Yeah, man, getting in the seat is the right move. I couldn't agree more with you. Well, this was a awesome conversation. Thank you everybody for joining. I know it's late. It's almost 6 p.m. on the West Coast, so it must be 9 p.m. on the East Coast, and around the world it'll be even later. So thank you again for joining and listening to this session. Hope you got a chance to look at different perspectives in DeFi yield, and hopefully there is some insights that we can all carry forward and try to bring the world forward that we're all imagining a year from now. So thank you everybody for joining. Have a good night. And thank you to our speakers for taking the time to join as well. Thank you, everybody.